Container volumes into the United States plunged a shocking 6.9% in May, reversing months of solid gains, and the story behind the numbers is even more important than the drop itself. What's going on? Global rates are unstable, tariffs are back in play, and shippers? They've flipped the script, pushing back against steamship surcharges and flooding alternative markets with American exports. Shocking May drop: U.S. container volumes fall nearly 7%. Let's start with the raw numbers. According to veteran maritime analyst John McCown, container volumes at the top 10 U.S. ports dropped 6.9% year-over-year in May 2025. That's a stark reversal from April's 9.6% gain and March's 11% surge. We were coming off a period of heavy front-loading due to tariffs, and now the slowdown has hit. West Coast ports were hit hardest. Los Angeles and Long Beach saw the most dramatic declines. Meanwhile, East Coast ports like Savannah and Gulf Coast hub Houston were more resilient, with Houston in particular showing gains in both import and export volumes. Interestingly, the West Coast made a brief comeback in April, driven by front-loaded shipments before tariffs hit. But May's data shows that East Gulf Coast ports reclaimed their lead, outpacing West Coast volumes by 1.9 percentage points, according to 3-month trailing averages. Still, over the long term, the trend remains clear. There's a strategic eastward shift. Now let's dig into container freight rates, which are just as volatile as the volume data. According to Zanetta, spot rates from the Far East to the U.S. West Coast have crashed, down 39% since June 1st. Prices hit a high of $3,317 per FEU at the end of June, barely above what they were before, effectively erasing the early summer surge. Far East to U.S. East Coast rates fell more modestly, down 9%, but still stand strong at $5,990 per FEU. $2,673 spread is now the widest in 10 months. As Zanetta's chief analyst Peter Sand put it, the Trans-Pacific into the U.S. West Coast is the key battleground, and carriers are losing control there fast. Let's talk tariffs. In April, President Trump imposed sweeping tariffs, some reaching as high as 145%, only to hit pause for 90 days. Carriers and major shippers raced to beat the deadline. According to Maersk, the effective U.S. import tariff currently averages 21%, down from 54% at its peak. Now July 9th is looming. Over a dozen countries are scrambling to strike deals before penalties kick in. And long-term, the global sourcing shift is real. Apparel and fashion brands now source less than 10% from China, according to Maersk. Meanwhile, U.S. grain exporters have adapted surprisingly well. New data from BIMCO shows seaborne grain exports rose 9% YoY in the first half of 2025, even with dramatic drops in shipments to China. Grain exports to China fell from 26% of U.S. total in mid-2024 to just 10% this year, but American exporters pivoted. New buyers in Latin America, Asia and the Med absorbed that volume. However, soybean exports are down 10% and sorghum is down a staggering 89%. Cargo volume's up, but check this. Ton-mile demand is down 7% YoY. Why? The destinations are closer than China. Back in Washington, the Federal Maritime Commission, FMC, just launched a major investigation into the World Shipping Council, WSC, the industry's biggest lobby group. At issue is antitrust immunity granted in 2020, allowing major carriers to share data, coordinate schedules, and discuss pricing. The FMC wants to assess whether these alliances act more like digital cartels, especially after shipping lines prioritized empty containers to China during the supply chain crunch, leaving U.S. exporters stranded. FMC Chairman Louis Sola, before stepping down in June, said, "I've never been a fan of the World Shipping Council's approach. They sued us rather than working with us." So what does all this mean? Imports are down, rates are falling, U.S. exporters are adapting, tariffs are creating chaos again, and regulators are back in the game. Is this a short-term blip, or a longer-term warning sign? What's clear is this: shippers now have more leverage than they've had in years. But will it last? That depends on elections, tariffs, global inflation, and resilience in key markets. What do you think? Is the shipping industry stabilizing, or are we just in the eye of the storm? Hit that like button, share this video with your team, and don't forget to subscribe for more insights on global shipping, trade, and logistics every week. Comment below where your cargo is coming from, and how the rates are hitting your bottom line.